with the Investing News Network, and here today with me is Paul Robinson, Director at CRU Group. Thanks for joining me today.
It's a pleasure to be here as always.
Okay, well thanks for coming. We're here at PDAC on the second day of the conference. Have you had a chance to get a sense of the mood?
So the mood is definitely optimistic. If I go back 12 months, there was a sign of cautious optimism in the mining sector and a hope rather than a belief that things were starting to turn. And I think in the last 12 months, we've certainly seen some solid foundations formed for demand that has helped on the supply side, and that's feeding through to the delegates and the exhibitors that are here this year. They are definitely more optimistic than they were 12 months ago.
And it's a justified optimism?
It's certainly justified in the short term.
Okay.
So we've definitely seen a pickup in demand across a range of metals in the last 12 months, and I think that is feeding some of that optimism.
Okay. So every year when you come to PDAC, you do a review of the previous year and you share your outlook for what's coming in the current year. Can you tell me what overall resource trends stood out to you last year?
So last year, 2017, I think there were three important resource trends. So the first one was across the board, we saw a stronger than expected pickup in demand. And there was nothing special about that. It wasn't one particular country or one particular sector that drove that. It was the fact that actually we had growth across the world. And we haven't had that in a decade. So we haven't had Europe and the US and China and Southeast Asia all performing well. And that lifted prices across base metals in general. The second thing that happened, which was a little bit more unexpected, was some of the environmental closures that took place in China, driven by their blue skies policy, driven by their blue skies policy, and that led to some capacity restrictions in bulk commodities and in steel, and again that lifted prices further, particularly for iron ore and for met coal and for steel prices, and that's a trend that we think is ongoing in 2018.
So any surprises for you there, positive or negative? You said that one was the surprise, yeah.
So, the positive surprise was the fact that the world got its act together and we had that growth across the world. And although our predictions last year in terms of the running order, strongest to weakest commodities, we were bang on, so I'm quite pleased with that. We underestimated the scale of that price uplift because we underestimated the scale of that demand uplift. I think the positive surprise for me is how strongly China appears to be tackling this absolute pollution level within China, and I think that's good for the environment, and it's good for the steel sector and good for the raw material sector. And as I said, that's a trend we think is going to continue throughout 2018.
Any new trends we should expect to see this year?
So I think there's two new trends. One is a continuation really, but maybe a ratcheting up of the trend around electric vehicles. Mm-hmm. So electric vehicle demand is coming, it is affecting and impacting a range of commodities. There is a little bit of hype there that is driving prices a little bit higher than they should be, a little bit earlier than they should do, but it's also worth noting that actually in general, analysts are revising up their expectations of electric vehicle auto forecasts every year. So we're still trying to catch up with that trend. And only at the end of last year, the Chinese put subsidies in place to increase the volumes of their battery electric vehicle market, and that doubled our forecast for Chinese battery electric vehicle markets by 2025. So I think that's one interesting trend. The second trend is around the environment. So we are starting to see announcements from China. It's not a done deal yet, but we've seen two announcements from the cities of Tangshan and Hangsang, I think is how you pronounce it, that have both talked about extending some of their steel cuts now into the summer of 2018. And again, if that happens, despite Section 232 and the tariffs, then that should again be supportive of steel prices and be supportive of iron ore high quality prices and met coal prices.
Okay, you mentioned the tariffs, and we just had last week the whole US tariffs announcement. What are your thoughts on that?
So I can understand the principles behind trying to protect the US aluminum sector and the US steel sector. And certainly, we have tariffs on a variety of things within the EU, so it would be hypocritical of me to sit here and say that tariffs are a bad thing. I think these tariffs are ill-founded, so I don't think they will achieve the results that the Trump administration is looking to achieve. So on steel, China is just a minuscule importer of steel products into the US, and actually there are a whole host of jobs and work associated with re-rollers on the west coast of America and other facilities that rely on some of that imported steel for their workers. So my concern there would be it won't have the results that they expect. On aluminum, even before this tariff announcement, at CRU, we already had the US aluminum sector returning because of the growth in demand. So our base forecast had all of that smelting capacity returning, and some of it was already energized to return. Therefore, this is just a tax on aluminum for North American consumers, I'm afraid.
All right. Mining companies, what activities should mining companies be engaging in right now? M&A, financing something else?
So it's a really interesting question. So if you look at the other thing, of course, that's happened over the last year is the free cash flow and the profitability of the mining companies, particularly those big corporates, has gone through the roof. And now we have arguments over what to do with all of that excess cash, which is a much better, healthy argument to have than how to cut costs. Really, they've got three choices. It's about paying down debt. Well, that's already been done, so we can tick that box. It's about returning cash to shareholders. I think that is the major trend that we will see in 2018, because shareholders need rewarding for sticking with it over the last 24 to 36 months. And then you've got M&A activity. At CRU, we expect M&A activity to restart again, but will still be muted. It's too early yet, and there is too much pain associated with bad M&A activity previously for it to be a massive splurge. Having said that, we think there's going to be opportunistic M&A and acquisitions and opportunistic brownfield expansions. We've seen First Quantum recently put out to raise capital to complete the Cobre Panama project, which is a very interesting market to be in. We have seen Southern Copper that have won the tender for the Peruvian Mexicali copper asset, which again is another right step for the copper market. And we've seen Nexa, of course, do their successful IPO last year. So there is some activity, but we don't expect to go back to the M&A frenzy that we saw before the last downturn.
All right. And investors, as an investor, how should you be behaving in this type of market?
So, as an investor, you've got to know your own risk appetite and you've got to know your own risk tolerance. So it's not for me to tell an investor which company is right for them. But what I would say is from the environment, the macro, the commodity trends, and CRU, certainly we favor base metals and steel over bulk commodities. So that's number one. The second thing we favor is we favor high quality, lower environmental impact commodities over the more polluting commodities. So high quality iron ore over low quality iron ore, high quality thermal coal, high quality met coal projects over low quality. And we believe the premiums and discounts on that quality benchmark are only going to grow over the next few years. So base and steel over bulks, but high quality bulks over low quality bulks.
Okay, perfect. Thank you for those tips. That was great to talk to you. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Paul Robinson of CRU Group.